Across the country, the modest subdivisions built for the American workforce between the 1960s and 1980s are failing. In many of these neighborhoods, the housing stock depreciates in a slow downward spiral. Vacant lots accumulate, existing homeowners are locked out of the equity they expected to build, and the resulting physical blight strains municipal budgets through increased police response and code enforcement. In other legacy neighborhoods, the exact opposite occurs. Absent stabilizing market forces, absentee investors identify cheap entry points and bid aggressively against each other for the area's thin inventory. This intense speculation drives rents up quickly and pushes owner occupancy rates down. Local buyers are entirely priced out of the neighborhoods they grew up in. Blight and runaway bidding wars share a common root, a structural breakdown in market information. When the data used to judge value disappears, prices become unmoored. The pricing signals that guide real estate markets have collapsed. To understand that collapse, we have to look at the primary mechanism of real estate valuation, the comparable sale, or comp. Appraisers determine the value of existing housing stock by pricing it against established benchmarks, which are traditionally anchored by new construction. But today, new construction happens almost exclusively on the edges of towns in brand new subdivisions. Those edge developments sit on different lot sizes, offer a different product type, and target a different price class. They are invalid comparables for a 50-year-old grid of houses. Because no developer builds inside these aging subdivisions, the legacy neighborhood is left completely blind. It lacks any recent in-ecosystem new construction to serve as a rational pricing anchor. Without a rational benchmark, property values become unmoored. Prices are dictated entirely by whichever extreme force is acting on the market, either the downward drag of distressed sales or the upward spike of investor speculation. This is the exact failure the Neighborhood Price Stabilization Protocol, or NPSP 3.0, is designed to solve. NPSP operates as an information repair protocol. The protocol centers on a single mechanism, deploying small-scale, base-specification infill housing exclusively as a localized pricing instrument. We build these specific homes on vacant lots to generate live, rational comparable sales where none currently exist. The strategy aims to restore a predictable stabilization corridor, correcting the market from the inside out without displacing residents. The NPSP base home requires rigid physical specifications to function correctly. Every unit must be 1,200 to 1,600 square feet, feature modest finishes like laminate counters and vinyl flooring, and have a roof pitch that matches the surrounding block. The protocol strictly enforces a no luxury creep rule. If a builder escalates the features of the home, the appraisal benchmark drifts upward, defeating the purpose of the stabilization corridor. This scatterplot illustrates how the base home acts as a pricing limit. When a new base home is built and sold inside the neighborhood, it sets a firm ceiling on local appraisals. No 50-year-old home nearby can rationally appraise higher than a brand new comparable model, capping speculative bids. Simultaneously, that exact same home acts as a floor. By providing a verifiable sale at construction cost, it stops distressed properties from dragging the baseline down. The protocol anchors neighborhood appraisals to actual replacement cost rather than demand speculation. A healthy 3 to 5% growth corridor emerges naturally from the math. A common industry misconception is that market stabilization requires massive construction volume.
NPSP achieves this anchor by building just 5 to 10 units per year. The protocol relies on one absolute financial rule: NPSP never predetermines sale prices. Every home is sold exactly at the value set by local appraisers. This bar chart illustrates the unit economics using a Midwest reference market. A total development cost of $195,000 to $230,000 lands against an initial appraised value of $175,000 to $185,000. This red section represents the resulting $22,000 to $30,000 gap subsidy required to close Phase 1. Because Phase 1 introduces higher comps to the neighborhood, the baseline appraisal elevates. When Phase 2 begins, the gap subsidy required mathematically shrinks. By year 4 or 5, the gap closes completely. The program reaches break-even. Each completed phase makes the subsequent phase cheaper to execute. The protocol earns its own financial exit and eliminates the need for perpetual public gap funding. To maintain the corridor, the pricing instrument must be defended against macroeconomic shocks. The protocol builds risk management directly into the timeline. If the local housing market slows down and sales stall, NPSP triggers a build-to-rent fallback. Units are held and rented out, yielding approximately 6.7 to 8% net. The protocol strictly forbids forced discount sales during a slowdown. Selling a home at a loss would instantly print a low comp, artificially dropping the signal the program was built to fix. This logic tree visualizes the defense against severe market overheating, the rate trigger protocol. If 30-year fixed mortgage rates drop 75 basis points in a 90-day window and local inventory falls below 45 days of supply, the protocol automatically triggers. This algorithmic trigger deploys shovel-ready reserve lots immediately. It injects fresh supply precisely when demand shocks hit, neutralizing bidding wars before prices escape the corridor. To prevent speculators from capturing this new supply, buyers are bound by a 5 to 7 year owner-occupancy deed restriction that includes resale recapture, eliminating the margin for house flippers entirely. These embedded algorithmic and legal safeguards ensure that the stabilization corridor holds firm, defending the municipality's initial investment regardless of external rate volatility. Municipalities do not need to wait for state legislation to deploy NPSP. Every tool required already exists in current municipal law. Cities execute the protocol using simple council resolutions, standard development agreements, and existing land bank dispositions to transfer blighted parcels to approved builders. The capital stack is simple. The city contributes 20 to 30%. A single federal source, home or CDBG, covers the 15 to 25% gap subsidy. A local bank or CDFI provides the remaining 55 to 65% construction loan. By actively avoiding the complex, multi-layered subsidies that slow down traditional affordable housing, the protocol minimizes compliance friction and accelerates physical deployment. The Year 1 roadmap moves quickly. In Quarter 1, the City Council adopts the NPSP framework and maps the initial target lots. Quarter 2 allocates the seed funding and selects a builder through an RFP. Quarter 3 delivers permits and groundbreaking, leading directly to a Quarter 4 ribbon cutting. Lasting stability in these markets is achieved through precise information repair rather than massive physical volume. A targeted commitment of just 5 homes per year is enough to restore the appraiser's benchmark and return a rational pricing signal to the ecosystem. By using small-scale infill housing as a pricing instrument, municipalities can interrupt the cycles of decline and overheating, engineering lasting stability from the inside out.